Welcome to today's market report.
European shares fell on Friday, hitting session lows after a downturn in US stocks on a tech slide and fears around the Omicron coronavirus variant hitting economic recovery. The pan-European stock 600 erased morning gains to close down 0.6% after swinging between losses and gains all week on worries over the potential impact of the newly detected variant and the US Federal Reserve's recent hawkish turn. US job growth data disappointed, but that failed bets that the Fed may consider tightening the interest rate, but Wall Street declined as tech heavyweights slipped. The next couple of weeks will remain volatile as the focus falls on the latest US inflation report, the December 15th FOMC meeting, and further clarity on the impact with the Omicron variant, according to Oanda. Data this week showed inflation in Europe surged, with Germany's hitting highest in decades, but the European Central Bank has maintained its transitory inflation stance. The ECB may set policy for a relatively short period at this month's meeting, given heightened uncertainty. President Lagarde said, IHS Markit survey showed Eurozone business activity accelerated last month, but the bounce may be temporary as demand growth weakened and fears about the Omicron variant put a dent in optimism. Basic resources sector lost the most to Europe on Friday, down 2.5% as copper and iron ore prices eased, while tech stocks tracked US peers lower. The day's moves pushed Stoxx 600 into the red for the week, down 0.3%. But London's FTSE 100 outperformed, up 1.1% on the week for its best such gain since mid-October. Oil stocks rose as crude prices climbed after OPEC Plus said it was poised to act if demand weakens and was the only sector in the black for the day. Brent crude was up 0.34% at 69.91. Crude WTI was down 0.35% at 66.27. Gold futures was up 1.22% at $1,784.15 per ounce. On the FX front, the British pound pairs Thursday's gains and some more is down some 0.5%, trading at 132.32 as risk-off market mood prompted investors to drop anything with the word risk attached to it, benefiting safe haven assets. The US, the yen and the SHIB are the most aided of the above mentioned and are the stronger currencies. As we approach the end of the week, the pound bounced off Friday's daily low around 132.10 towards the 132.40 figure on a steady move that could have been prompted by US dollar profit taking. Also, US dollar bulls failed to break the 132 figure on the back of the not so bad November's non-farm payrolls report, which in the case of have been in line with estimations or better, the cable would indeed be trading at new year-to-date lows. As mentioned earlier, the US economy added 210,000 new jobs, shorter than the 550 estimated by experts. The headline showed a worse than expected report, but the unemployment rate dropped from 4.5% to 4.2%, reinforced that the labour market is improving but not at the pace required. Additionally, the Fed seems to pivot from the maximum employment goal towards tackling inflation, as Fed Chief Jerome Powell said on the week that inflation is no longer transitory and should be no longer used when speaking of elevated prices. Therefore, as the Fed pivoted towards inflation, the US Consumer Price Index for October on Friday of next week would be the primary driver for GBP/USD traders, followed by the University of Michigan Consumer Sentiment for November on its preliminary read. After seesawing before the Wall Street Open on US macroeconomic data, the euro-dollar advances more modestly, up some 0.1%, trading at 113.09 during Friday. The market sentiment is downbeat, as portrayed by US equity indices falling between 0.77% and 2.61%. The US bond yields aim downward, while the greenback is flat during the day, with the dollar index sitting at 96.16. The Aussie dollar pair is in freefall, trading at 0.7018, its lowest since November 2020, while the markets feared that the new variant could delay the already tepid economic comeback while exacerbating supply chain issues. One of the reasons inflation is ultra high globally.
This is today's market news. Thanks for listening. We'll see you next time.